about accounting. You may want to go ahead and, spend 30 or 40 bucks a month on QuickBooks Online and take a crack at doing your own books. If you're growing really quickly and accounting isn't your strength, this could be when you start considering bringing on someone to help you. But I still don't know that it needs to be your core focus. Again, if you're a well-funded startup, you probably already have books at this point. By the time you crest 20 grand a month, so you're at 20, 25, $30,000 a month in revenue, you probably need to have a scalable system of some kind to manage your accounting. And if you don't, this is the moment. By the way, if you get to $20,000 a month in revenue and you don't have an accounting system, this probably means that you hate accounting, and that's okay. But this is when you may want to consider either hiring somebody or outsourcing to a firm like mine to take this burden off of you, but also give you quality books.
All right, thank you, Tyler. And could you also, I want you to go into a little bit about the biggest accounting mistakes that you see Amazon sellers make and a little bit about how you avoid those mistakes as well.
Yeah, so the biggest issues that we see over and over and over again are, if you can kind of put it simply, it's just not knowing where your money is, right? This is my money, I own this business. Where is that money going? And having some system, even if it's just a spreadsheet, for understanding how profitable each of your SKUs should be, and then comparing that projection to real numbers, that's accounting. Like, we could kind of hard stop. That's what accounting is. And so you need to have some system. In other words, the biggest error is opting out. You need to at some point opt in to managing your money. The other biggest issue that we see over and over again is just sellers not managing their books on an accrual basis. So your ability to attach your revenue in a given month to the expenses that actually associate with that revenue is the only way that you can actually answer the question, did I make money last month? And if you don't have an accrual method of your accounting, I would recommend exploring changing to that. I'm really glad to be talking to Mike today, because having some kind of a coherent tax strategy is really one of the biggest errors that we see. We don't do the taxes at all, but just sellers that haven't thought about it. I'll deal with that later. At some point down the line, that becomes a gigantic liability. And I think maybe just another small error that we see pretty recurring is if you're selling through different channels, you've got pretty good traction in Canada, or maybe you have a Shopify site, but you aren't splitting those revenue numbers kind of so that you can tell where the money's coming from. It's really hard to know where you should place your next bet if you don't know whether Amazon US versus UK is making you money. So I think those are the common issues. And then, again, avoiding those mistakes is just incrementally, as you grow, adding more sophistication to your accounting system. I mean, what I mean by sophistication is just having a system, like, integrating your bank account with some kind of an online banking accounting system like QuickBooks Online, and then just doing the hard work of looking at your numbers every week and every month to see where you are financially.
Right. Thank you so much. Oh, go ahead, Mike.
I was just going to dovetail a little bit, since we're talking about mistakes. And, this applies not only to Amazon sellers, but pretty much all new businesses. And when it comes to sales tax, there's two problems that I see. Number one is starting too early. I mean, some people, before they even start selling, are worried about running out and getting registered in all the states. And, like Tyler was mentioning, let's make sure that your business is actually going to be a viable concern, that it's going to be able to make money on a going forward basis. We can always come back and layer in the sales tax, state at a time, or 2 or 3 states at a time. So many people that I see just want to go out and get registered everywhere. And that can be a big expense for a brand new company. The second mistake I see is waiting too long. So while you don't want to get started too early, you don't want to be 5 years down the road and, be doing that, $100,000 a month and now start worrying about sales tax. So the biggest mistakes I see along those lines for brand new companies is number one, starting too early, or number two, not even thinking about it, or starting too late.
Agreed.
Thank you. Yeah, thank you guys so much. So Mike, we talked a little bit about those mistakes regarding sales tax, and I think everybody is well aware that sales tax is kind of this ever-changing, growing beast. It's easy to make mistakes. So what is the latest regarding sales tax right now?
Well, we've had a lot of changes in the last year. We're coming up on the anniversary this month, June 21st. And what I'm talking about is the Wayfair case. And for those of you who may not know what that is, it's a U.S. Supreme Court case that threw out the need for a physical presence in order to create nexus. And nexus is just a fancy word we use to mean a link or a connection. And that's the link or connection that has to be present before a state can require you to collect its taxes. So that's the biggest news that's happened in the last year, is that we no longer have to have a physical presence in order for a state to require you to collect its tax. You can just be selling a certain dollar amount or a certain number of transactions into a state. South Dakota was the state that was involved in the Wayfair case, and they have $100,000 or 200 transactions. And it's the 200 transactions that is really catching a lot of the smaller sellers out there. But we've seen some good news lately. There's been a trend where we're seeing states move away from the 200 transactions. States like California were $100,000 or 200 transactions. They now have moved to $500,000 and they've done away with their transactions. States like Washington and Colorado and Iowa, North Dakota, these are states that originally came out with $100,000 or 200 transactions, and now they too have eliminated their transactions. So all of these states are just at the $100,000 level. And then we've had some states come out like a Texas, and they have said, why bother with the 200 transactions? We're just going straight to the $500,000. So that's one trend that we're seeing that's really good news for sellers of all sizes out there. And then for marketplace sellers, and Amazon is a marketplace. I mean, if you're selling only on a marketplace, a lot of great news, because a lot of these states are requiring Amazon to collect the tax on behalf of these third-party sellers. So right now, I think there are 26 states that have passed this. We expect a lot more. By this time next year, we expect pretty much the vast majority of states, upwards of 40 states, to have passed some sort of statute requiring Amazon to, or other marketplaces, to collect the taxes. In most instances, seller doesn't have to stay registered or get registered if they're only selling on a marketplace. Whole different story if you're selling on your own website in addition to Amazon or some other type of marketplace.
So Micah, I feel like that's a great leading answer into this next question here. So how should the average seller approach whether or not to file in the different states?
Great question. Really, there's a couple things you have to look at. And sellers should register to collect tax whenever they have nexus, whenever what they sell is taxable, and they are the ones responsible for collecting the tax. We just talked about the marketplace may be responsible. And the fourth thing is materiality. And I think that we need to use common sense, because some of these states still say 200 transactions. And if you're selling a $5 or $10 item, I mean, that's $1,000 or $2,000. The cost of compliance could be greater than any penalty or interest that you're, and back taxes you pay out of your own pocket. So the states, don't say anything about materiality or common sense. They really pretty much want you to collect tax from dollar number one, and your filing frequency will just change. But I think that we have to take that into consideration when deciding when we should register or not. So going back again, whenever you have that link or connection with the state that we call nexus, that's got to be present. If you don't have nexus, then you don't have to worry. The state can't force you to do anything. The state can't require you to collect its taxes or pay its taxes. It all starts with nexus. So the nexus has to be present. What you sell needs to be taxable. Each state views products and services differently. So what's taxable in one state may be different than what's taxable in another state. Then we've got to look at materiality. And finally, we've got to look at who's responsible. So if you're responsible, your exposure is material, you have nexus, and what you sell is taxable, then you should be getting registered to collect the tax.
Thank you so much, Mike. Okay, Tyler, could you tell us a little bit about the keys to measuring and driving profitability for e-commerce sellers? We're going to take a little turn here. So take it away, Tyler.
Sure. Yeah. So, man, Mike, your comments are always so clear. By the way, I just want to say that I really grateful to have you as a partner. Your firm does a good job on the sales tax stuff. It's a big deal, and taxes can become one of your largest line items that can impact cash flow if you're not careful. And so definitely appreciate your comments there, Mike. So, when it comes to actually measuring, so one of the hats I wear is there are about 25 sellers that depend on me directly to be their outsourced CFO. So it's not all of our clients, but a subset of them that lean on me for profitability coaching. And I think the big thing is just to understand the business we're in, and then to measure the right things and take action when they're out of line. So the first metric that I would recommend, if you're not measuring this, take a look at it maybe as soon as possible, would be, it's a metric called Seller's Discretionary Earnings, SDE. If you're interested at all in valuing or selling your e-commerce business, SDE is one of the most important metrics you can measure. And what SDE is your your all-in gross profit. So you take your revenue minus the factory cost, but minus all of your shipping costs, minus your Amazon-related fees. And then you actually get this thing called gross profit, but we want to subtract one more thing from gross profit, which is your direct advertising expenses. And what you're going to be left with is what's called seller's discretionary earnings, or basically this is a measurement of how much cash do my core products spin off that I can then choose to apply. In other words, discretionary in the sense that I can choose to apply that cash to wages or to software or to research and development new products or to debt payoff or anything like that. So if you're not measuring SDE, you need to be keeping an eye on it. You want to be growing it. If you're interested in understanding what your company is worth, it's going to be a multiple of that SDE. That's really what the investors 100% care about. Another metric that will help you understand the profitability of your business is just thinking about everything else, right? We've talked about the seller's discretionary earnings being your sales, direct expenses, but then everything else on your profit and loss statement is what you would call overhead. And especially if you're a smaller company, you just got to be as lean as possible. Things are dynamic. Amazon's changing. The international competitors are moving in very quickly. And so if you're either an accountant that's helping e-commerce, or if you actually are an e-commerce seller yourself, being as lean as possible is critical right now. Another thing that I think that is underlooked at in these e-commerce financial statements is inventory turnover. So really understanding how quickly your business can, you take cash, you buy goods, how long does it take me to get a return on that investment? And then that kind of leads into another metric, which is return on inventory investment. So how much profit am I getting for every dollar I put into inventory? If you don't care about these metrics, you're going to have some, depending on your business model, you need to figure out if you are a private label seller that has a very limited amount of intellectual property, you're going to care a lot about keeping your inventory levels as small as possible and keeping your cost of borrowing money as small as possible. That means if you want to be profitable in that model, you're going to have to be a little bit less aggressive on your growth. If you have a utility patent, for instance, or if you have a lot of protectability around your brand or your product, you can afford to have more cash outstanding because you're going to be able to have higher margins on your product. So I think all sorts of other metrics you could look at, like review quality for SKUs and that kind of thing. But if I were managing an e-commerce business today, seller's discretionary earnings, keeping my overhead as low as possible, and then keeping just a laser-focused eye on my inventory metrics, those being how often can I turn over my inventory and how much profit am I making on those inventory investments. And then what I would say is take whatever your favorite 3 to 10 of those metrics are and toss them into a dashboard or purchase a dashboarding tool where you can see them on a real-time basis and use that data. That's what we love, data in this world. But sometimes we're so inundated with data in the Amazon or other e-commerce world that we fail to just focus on the key metrics that really deserve our attention. So that would be my advice: is pick the 5, 3, 10, however many it needs to be, and make sure you can answer that question. What was your SD last quarter? What was your overhead percentage last quarter? How many days of inventory do you have in stock? That kind of thing.
Yeah, I'd like to add something in there and get your opinion on it, Tyler, also, especially when people are first adding sales tax. And this is specific to Amazon sellers. Um, uh, there's got to be some way that they can account how they can measure what their cash flow actually consists of. Because so many people, they may be signed up and their filing frequency is quarterly. They're signed up for us to do the returns. We say, okay, here's how much money you need to give us to do the returns. And they come back and they say, well, get it from Amazon. Well, what they don't understand is that Amazon has been dispersing that to them in their regular disbursements. It's included. It's all lumped together, and they're reinvesting it or spending it however, and then they don't have the money to go out and pay the sales taxes, which can be a huge problem.
Yeah, especially if you're filing quarterly or annually, like you're describing there. Yeah, that's another one of those key mistakes that we see often is if you get a deposit from Amazon or from, say, Shopify, and that deposit includes sales tax, and you just add that deposit into your sales number on your P&L and forget about it, like Michael was just saying, then when that tax bill comes due in 3 months or in 6 months, you're going to have an oops. And so I think an important factor in doing your accounting properly is to make certain that you have some way of splitting that sales tax liability. Don't let it inflate your profitability. You're going to have an overinflated picture of what your profitability is. Make sure that it's actually on your balance sheet in a liability account where you're like, oh gosh, I actually owe $1,000 to the state of California. And then, if you have very, very little cash reserves, you may open a second account and just move that money over to kind of have that cash be out of sight, out of mind. But at a bare minimum, every month, be aware, okay, this is cash that's coming due in the next month or two. Michael's going to be asking me for it. It's not his fault. The state needs the money. I need to make sure that when I'm making my investments, deciding to hire people, deciding to invest in more inventory, deciding to launch a new SKU, that I'm not spending money I don't actually own. Because that's exactly how the state views it. As soon as you collect that money, you're holding it for them. You're a steward, but you don't own that money. And you need to keep it separate so that you can turn around and remit that to the state.
Yeah, absolutely.
Yeah.
Just like payroll taxes, it's never your money. It's either the state's money or your customer's money. You're holding it in trust, and the state doesn't take very kindly when you're using that money to fund your business. Some people on purpose, and other people just accidentally because they're not keeping track of what that cash flow consists of.
And Michael, you bring up a good point there. I think this is just something to be aware of. If you didn't know this, just know that when Amazon makes those deposits, they aren't keeping that sales tax money to remit on your behalf, unless it's one of those growing number of states where they're filing on your behalf. But if you are responsible for filing, just know that in that nice little 14-day deposit they send you is a little bit of money that you don't own. And I think maybe that knowledge is probably more powerful than anything else, just to know, hey, I got a problem here. I've got to figure out how much of this money I don't owe, I actually don't own, and therefore owe to the states, and go ahead and earmark that money so I don't spend what I don't actually have.
Absolutely. Very important.
Yeah, thank you so much, guys. And I want to just throw in there again, you guys, if you have questions as we go along, please just shoot me a message in the chat box or the Q&A, and we will get to those at the end or email you afterwards. So Mike, let's talk a little bit about sales tax liability and how it impacts the enterprise value when an owner tries to sell. So we're talking a little bit about measuring that profitability, but let's talk a little bit about that liability side as well.
Yeah, in general, the liability is always going to follow the assets. So there's an exception to every rule, but that is the general way that things work. And this is very surprising because even a lot of CPAs and accountants and attorneys that I speak to don't understand this. And they say, well, we're doing an asset sale. We're not doing a stock sale. And, well, the liabilities are still following those assets. So you don't want to acquire someone else's problems. And the worst time to find out you have an issue is when you go to sell the company. We were involved in one. This was not an Amazon company. But they put themselves up for sale, and they found out they had a problem when the purchaser said, hey, you've got independent contractors all over the country, and that is Nexus creating. And everyone loved the sales price. It was $30 million. It was a father-son team, but we want to put roughly 50% aside to cover all of this potential exposure. And the CPA, who had been doing their books for 30 plus years, about had a heart attack. He said, oh my, how much exposure, not only did, this company now have, but what type of exposure do I have? I've been signing off on the books, giving them clean opinions, doing all these audits. And, he called us in a panic and said, hey, is this just a negotiating tactic? And unfortunately, it's not. The company didn't want to acquire their sales tax problems, so they were making them put money aside. Anyway, we were successful in getting that number down to a point where everyone was happy and the deal ended up closing. But not every story has a happy ending like that. And it's not only the states you got to worry about. Sometimes it's the company that you are selling to. They're going to let you know all of this bad news, and you're coming out of pocket what should be a great time. You're enjoying the fruits of your success in selling your company, and now you're have to pay the states at that time. So very important for you to understand what your exposure is as you're approaching a sale, and how you're going to work with the purchaser. There are a number of different ways you can do so to work through that. And nowadays, just about all of the big companies out there that are acquiring other companies are making sales talks part of their due diligence process.
And Michael, I can affirm that. So I've had several private equity groups hire my firm to do some of the evaluation, some of the due diligence, and over and over and over again, the question does pop up. So first of all, know that if you want to sell your business, the sales tax will come out. It's going to come out in due diligence, and your ability to explain what your strategy was and how you've either mitigated that risk or have some funding set aside to handle the risk if you were to be audited, is really important. And I think, if you do want to sell your business, I would just say my advice to all of our sellers and the clients that we represent is just put yourself in the investor's shoes. An investor is buying a stream of cash flow, and they are going to be zealous to try to find out how much risk there is to that cash flow. And anything that is, anything that's a part of your books or a part of your business model or a part of your liability that makes that buyer a little less sure of the business is going to impact your valuation. So even if the deal doesn't fall apart, which I have seen deals fall apart, but even if the deal doesn't fall apart, it does harm the valuation that you're able to get, and it just behooves you as a seller to make sure you're on top of it. Just make sure you understand where your liability is. And if you have some, maybe you picked the state and decided to, that it wasn't material, as Michael was mentioning earlier, disclose that really, really early in due diligence and say, hey, here's 3 states where we didn't feel like we had a material exposure. We just wanted to tell you, here's how we've handled it. Here's our strategy. Because what you don't want to do is have a buyer go into due diligence with you and then have some trust red flags pop up, where they start thinking, oh boy, is this guy or is this lady really running a high integrity business, or is this person trying to scam me out of my money, and then I'm going to be left with a bunch of liability when the hammer falls next year. And so just know that it matters. It really is important.
Yeah, we've seen in the beginning, a lot of companies were buying, these e-commerce companies, the FBA companies, and they weren't doing their due diligence. So that was an important issue. And then some of them, found out the hard way that, oh, wow, this is something that I do have to pay attention to. And outside of e-commerce, for years, it's just been standard practice during the due diligence process. And nowadays, I find it extremely rare that someone is not including sales tax as part of their due diligence process. And we're seeing more and more of that. VDAs, clients are asking us to perform any way that they can minimize any of their past exposure. And again, if it's not material, generally the purchaser is going to take the same approach that we do, which is who cares? But if it is material, generally they're going to want you to either indemnify them or put money aside in an escrow account or get it cleaned up before the sale or take a reduced sales price. I mean, there's lots of different ways that someone who's going to acquire your company will want to structure this, but it's definitely something that needs to be addressed. Sometimes, rather than, the seller doing the due diligence, we've been approached by companies who are saying, hey, we're about to get sold. We want to do our own due diligence so that we know what our potential risk is, so that, if this comes up, or we can disclose it even and be able to talk about it intelligently before the purchaser, blindsides us with it. So it's important, no matter which side of that equation that you're on, that you're, looking at the sales tax side of the equation.
And Michael, just one more comment. That's just great advice in general, by the way. If you are within 12 months of a potential exit, just to have a couple of objective experts in your field come in and just give you an honest risk assessment. I think it's almost like the more you can tell on yourself, the more honest you can be on the front end, and frankly, if you have a year, you're going to have some months to try to clean up some of those boo-boos. But what you don't want to do is you finally have somebody roped, right? You've got them roped in, you've got a letter of intent on the table, you enter the first week of due diligence where you've all of a sudden released all this financial information, and the CPA or the firm like mine that's representing the buyer takes 3 seconds to look at your books and says, oh my gosh, what's the sales tax strategy? Or, oh my goodness, why is the accounts receivable out of whack? I mean, so it's just having somebody who isn't your bookkeeper, maybe even currently, if you have your friend doing your books for you, they may not have an interest to tell themselves if they've been doing it poorly for the past 4 years. Just do your own due diligence and put yourself in that investor's shoes, and you're going to find that the deals go through at a much higher click. Your broker's a lot happier, and you're going to make a lot more money at the close.
Hey, Tyler, you said something great there. Someone who's been doing this on their own may not be able to catch their own mistakes. Sometimes we're blind to what we're doing. So using a third party is a good idea on this. I'll share one experience, and this happens quite often, but this woman was a bookkeeper for a company for 10 plus years, and she didn't know what to do with the sales tax. So rather than account for it correctly, she was just, at the end of every period, journaling it back to the general ledger. And this went on for 8 years in California. They had 8 years worth of tax collected and not remitted. And no one knew about this until she got fired. And then it all unraveled at that point. So, sometimes it's malicious. Sometimes it's just they didn't know any better. But bringing in a third party to just check and make sure everything is copacetic is a good way to catch, even if you're not planning on selling your company. It's just a good way to find out where you stand, because the worst time to find out you have problems is under audit. So.
Yeah, I was going to say one more comment, kind of on the flip side of that. We had a client hire us to do just what you're describing, and he was having a couple of his balance sheet accounts that he couldn't get to balance. And we took a look at it. We discovered that he had been manually entering a pretty large number of Shopify sales for the past 5 years, and had totally forgotten to account for the shipping income for like 4 or 5 years. And so there was we literally found almost $350,000 in additional earnings that he just didn't have. And so now he's putting a packet together for these investors, and his valuation, even though they're really looking the most recent year, but his valuation went up quite a bit because he just captured all of his sales. Right? He had shipping income that just wasn't being captured. And so I would say this: I own an accounting firm. I have employees, all of us do different work. And the rule in our business is that nobody grades their own paper because we're all human. Like these are humans trying to do highly technical things. I mean, I get glassy eyed like you do when I look at numbers all day long. And so even if I'm doing work, and I'm a pretty seasoned accountant at this point, there's somebody else that's a part of our quality assurance department that's going to take a look at my work so that we're even fairly certain that we're getting the job done for our clients. And I would say the same is true if you're hiring your spouse is doing the books, or your cousin, or a VA, or a firm, even a firm like mine. Just have an occasional, especially as you get to a big moment. You're going to bring on a partner, you're going to raise cash, you're going to sell. Like Mike was saying, bringing in someone that doesn't have a dog in the fight that can take a look at it and say, this account that you've been ignoring for a year and a half, why is that still sitting negative? What's going on here? And literally just having someone that doesn't know, they're ignorant, so they have to ask the question, a lot of times can help you uncover some issues that need to be fixed.
Great points.
Yeah, thank you guys. That was some really great back and forth there. And we're going to switch gears for these last couple questions just a little bit. I think that it's something that's probably of interest to a lot of people here, Tyler, but tell us a little bit about how profitable the average Amazon seller really is.
So what my firm did, and I sold my former business at the end of 2017. So this is only our second full year in business, kind of like your firm, Michael. And so, but what we did was we took all of the data we had access to. It was somewhere, I think, between $40 and $50 million in Amazon sales, and just kind of created a little aggregate study to try to see what our average seller, how they were performing. And what we learned is that they're on average not as profitable as I feel like they should be. that was my take as the CFO guy. But in general, just to give you a couple of quick nuggets, our average client had about 30% of their sales in product cost of goods sold. They were paying Amazon FBA fees of about 20%. They had Amazon commissions, of course, of about 15%. And a couple of auxiliary expenses where their gross profit. So they're, call it $1 million. They have $1 million in sales for the year. By the time you take the product cost, fulfillment fees, commissions, storage, they've got about 30% left. And then the average seller was spending about 10% on advertising. So that number that I described earlier, the seller's discretionary earnings, we saw across the board that if you were a $1 million seller, you were averaging about 20% or $200,000 in discretionary earnings. You have some overhead, that was about 15%. So think about, of that 200,000, 158,000 gone. Now for the smaller sellers, they're paying themselves, so they're a part of the pie there, if you will. But overall, across the entire board, our $1 million seller on average was doing 5% or about $50,000 in annual profit for 2018. I think that's because a large number of our sellers are paying themselves, so there's maybe some seller compensation that's captured in the overhead. But let me just say this. I think for you, as you're trying to plan for your business, you're working really, really hard, and you shouldn't be working really, really hard to make zero money. And so I think that's, Michael, you made the comment really early on about actually being honest and testing the viability of your business, actually asking the hard question, am I in a business that is sustainable? If nothing significant changed, my most brilliant accounting professor, which is, I love this guy. He was brilliant because he was able to take the most complicated concepts and turn them into smiley face versus frowny face, right? If nothing significant changed in my business in the next 12 months, am I going to have a smile on my face because of the profitability? That's an intuitive way to look at it. If you're working 40 hours a week in a business plus and you only made $30,000 last year on a business that did $1 million in revenue, boy, there's a lot easier ways to make a living. And so I think that's where I've had to try to help some of our sellers. Let's just look honestly at the business model. Let's identify where you're overspending money and try to place our investments in some better categories or in some better product sets to really capture some more margin. Let's eliminate the overhead. But if you're looking for a quick rule of thumb, if your seller's discretionary earnings, that's your gross profit minus advertising, isn't 20%, you really need to start taking a hard look at changing the blend of your SKUs to make them more profitable, securing more intellectual property so you can raise your prices, lowering your cost structure. You are treading water at 15 to 20% seller's discretionary earnings. if you're lower than 15% SDE, you're running a business that is not going to survive with any significant changes coming out of Amazon or Asia or anything else.
And Tyler, just to share some experiences that we have, 2%. And when I ask people, what's your thought process here? Well, we're building market share. And as soon as we have the market share, we're going to raise prices. What's your experience if your whole sales process is built around low prices? What happens when you raise your prices?
Yeah, no, it's really tough. So you're talking about kind of a net of 2%.
Yeah,
that far down my P&L here, but I would agree with that. We're seeing our sellers are pretty high performing, but they're about 5% before taxes and about 3% gets to go in their pocket. And I was really shocked at that number. It's lower than I would have expected it to be. And so maybe to speak to your question, Mike, if your fundamental business strategy is to buy business, and if I can survive to a certain amount of scale, there are companies who have successfully done that. They're called Amazon.com, right? The ability to, Bezos borrows money at historically low rates for 15 to 20 years and becomes the richest guy in the world. For most of us, and I say most of us, including me, I built a home healthcare company prior to this venture, and I scaled from 0 to 120 employees in 4 years and lost money for 3 of those 4 years because I was scaling too quickly and I wasn't disciplined enough to take my own advice, right, and to slow down. So I think what I'm seeing in the Amazon space right now, the opportunity is not going anywhere. The opportunity is going to be here for a few years, but understand that you need to run an adult business. Like that's what I had to realize 3 years ago at the other company was it's time to make some money. I'm working too hard. I've got to find ways to actually build a product set or a service set that are sustainably profitable. And that's why I made the comment earlier, if nothing significant changed in your business, do you have a smile on your face? I think the classic entrepreneur, and I'm one of them, is so fundamentally optimistic that the fact that I don't know if you've ever done this, Mike, but if I look at like a projection, I'm losing money, and then actually as soon as it gets into the future months, all of a sudden I'm making lots of money. Like in other words, I'm making my guess of what's going to happen in the future, and every month that's a current month is negative. but sometime in the future I'm going to make money. And what I would say is just be objective enough to look at the products without them being your baby, and be realistic enough to say, okay, if this doesn't change dramatically, if I don't triple my margins by the next year, am I still going to want to be in this business? And if the answer is no, you've got some power to do something about it now, to make some different choices.
Yeah, absolutely. And when you say that, it ties into what we talk about in sales tax also. Being proactive gives you a lot of options. Mm-hmm. But if we're reacting to whatever, we're looking at, our options are fairly limited. I mean, we don't have the ability to take the full range of choices that we may have had if we were being proactive. So no matter what you're doing, I think that's important to realize, being proactive.
Agreed.
Making that change, before you don't have a choice in what changes need to be made.
Thank you, guys. That was really great. And Mike, let's just end on this last question. And we actually already touched on it briefly, but I think it's an important, do you have an opinion? And to be clear, again, this is just an opinion. Will Amazon crack across the board, and when? And again, I know you touched on this briefly, but I think it is something that is on everyone's mind. So yeah, thank you.
Yeah, before Wayfair happened, I was predicting a 3 to 5 year period. And since Wayfair, that has accelerated. And now I'm saying that by the end of next year, pretty much all of the states, there are 45 states plus DC that actually have a sales tax. I'd say upwards of 40. Maybe it's 42, maybe it's 44. It could be all of the states. If there's a state or two that's a straggler, then the following year, I suspect it. Right now, there are 26 states or so, that maybe up to 27 now. But we'll see more states before the end of the year is out, forcing Amazon and the other marketplaces to collect. By the way, the marketplaces don't all jump right on and say, okay, here's the effective date. We're going to start collecting. Like right now, Colorado is saying that as of 6/1, all the marketplaces need to be collecting. And then when I checked this morning, I still didn't see that Amazon was collecting, and they're usually the first one that jumps on. They usually let everyone know 3 or 4 or maybe a week before, not like they give you a whole lot of lead time. I mean, some of these are announced, 6 months in advance, and they don't tell you till the last week, so it's kind of hard to plan. But Amazon's usually the first one out there. You've got eBay, who's usually the last one out there. They're lagging well behind the Walmarts and the Etsy's and everyone else. So not all platforms are going to jump on board at the same time. But the states, by this time next year, will have, I think, most of them will have passed some sort of statute or guidance requiring that the marketplaces do begin collecting. And some of them, may become effective in October or November. So by the end of next year, we'll see, Amazon pretty much collecting in the vast majority of states.
Thank you so much, Mike. And Tyler, why don't you just kind of summarize for us and tell us a little bit about how Seller Accountant can help sellers, who they need to call, and how they should contact your team if they'd like to reach out to you. And then Mike will have you do the same.
Yeah, thanks, Ellie, and thanks, Mike, for letting me join you for this webinar today. So Seller Accountant, selleraccountant.com is the website. You can learn more about our services there. But we don't do income taxes. We don't do sales tax. We are an outsourced bookkeeping and outsourced CFO shop, and we only take e-commerce clients. And so if you are an e-commerce seller that, again, has kind of crested that $15,000, $20,000 a month in revenue, and you're looking to get organized, get control of your books, but even more importantly, have the visibility to drive the performance of your company forward, you might be a good fit for Seller Accountant. So I'd be glad to have anyone on this webinar email me directly. It's just my first name, Tyler, Tyler, at selleraccountant.com. And that would be a great way to get in touch with us. And if we might be the right fit, I'd love to talk to you.
And Tyler, thank you for joining us today. It's been very enjoyable. This is a new format for us, and I think we're going to do more. You were a great way to start off the series. So a little bit about sales tax and more for those of you who don't know us. I founded the firm here, and while we are very well known for our work with e-commerce sellers, we work with CPAs and virtually companies in every industry of every size, from your local neighborhood dry cleaner all the way up to your big, multinationals, let alone multi-state companies. We only offer services in the U.S., Canada, and the U.S. territories, most notably Puerto Rico, but our clients come from all over the world. So if you've got a sales tax issue, and by the way, people ask me, what's the NMORS about? Well, we do a lot of income tax consulting. We do a lot of Secretary of State work, a lot of registered agent work, anything at all that is pretty much related to state taxes. We don't do income tax returns. We've got a lot of CPA partners out there that do it, but we do a lot of consulting when it does come to income tax. So for those sellers out there, whether you're e-commerce or whether you have clients who have issues, then we're here to help.
Thank you guys so much. And I do want to end with at least one question here from our attendees. And this is for Mike. So Mike, the question here is, say that you have nexus in a state by remitting the sales tax costs a lot compared to what is being remitted. What level of sale is worth registering and remitting sales tax?
This is probably the most frequent question that I get. And my answer is, it depends. And it depends on you yourself. And we'll touch on a couple of things that you should look at. But I can't answer this because, $100,000 to Coca-Cola is like a rounding error. whereas $100,000 to me is a whole lot of money. And it's like that for every seller. What's a lot of money to you may be entirely different than what's a lot of money to me. So in general, I say that whenever your cost of compliance is going to be greater than any back tax plus penalty and interest that's going to come out of your pocket, then it just doesn't make sense. I mean, why pay someone like me more money than you would pay the state directly if they showed up on your doorstep? So generally, I can't make the math work if you're below $3,000. Now, that's $3,000 in gross sales in any one state on an annualized basis. Now, that doesn't mean you run out and get registered at $3,001. State may tell you to do that, with the exception of Tennessee. But that's where you got to use the common sense. And the things we look at are, does this keep you up at night? I mean, we have people who call us all the time and they literally can't sleep. If that's you, use the $3,000 threshold. If you tell me, Mike, I go to Vegas every weekend, I've never lost in my life, nothing bad has ever happened to me, and I don't think a state's going to find me, then you can be a lot higher than that $3,000 threshold. Maybe you choose a $5,000 or a $10,000. I had one woman who told me, well, I'm going to use $100,000. And I know all the risks, but I'm okay. Well, that's fine. I would say that if we're looking at 98% plus of our clients, they're somewhere between 3,000 and 20,000 as to their personal threshold. And if we drop down to 80%, they're somewhere between 5,000 and 10,000. And, profit margin plays if you have that 2% profit margin, like some people I talk to, you got to be closer to the 3,000. And this is counterintuitive. You usually say, well, I can't afford it. Well, how can you not afford it if the average sales tax rate is 8%? You add another 50% on top of that for penalty and interest, you're looking at 12%. If a state finds you, not have you only wiped out your profits in one state, but you may have put your company out of business. So cash reserves, if you can pay this out of your cash reserves. But again, most FBA sellers are putting everything right back into the business or spending it. So the more cash reserves you have, the higher threshold, the higher profit margin, the higher threshold. So I hope that explains, how everyone's got to choose this level on their own. But it's for every $1,000 in sales you have, it's roughly $120 in potential exposure. So you don't want to look at it as if a state found you this afternoon, but what happens if they found you 3, 4, 5 years down the road? So at $10,000, that's $1,200 a year. 4 years down the road, that's $5,000. If you can look at that and say, you know what, I don't want to pay that, but I don't have any problem whatsoever, then that number's not material to you. If you say, hey, $5,000 is a lot of money, and I could have paid someone to, figure out my taxes for a whole lot less than $5,000, then that money's material and you should be collecting the tax. Now, materiality is all about me. Or other people like me saying this. The states, if they come after you, they're going to want their money. They're not going to say, hey, Mike told me this wasn't material, and that's not a valid defense. If a state finds you, they're going to want that money.
Hey, Mike, can I ask you a question?
Sure.
So because Amazon is incrementally owning the sales tax compliance burden in each of the states, and you're saying probably by the end of next year, a critical mass of those states will be on board where we won't encourage new sellers who are 100% Amazon to register, say, in California, New York, or Texas. What advice would you give a seller who has decided to register, say, in California? If I'm not mistaken, I think California is going to make Amazon start collecting in October. What does that person do? Now they've done it. They're on the rolls for California, but they're 100% Amazon. What should they do? In
most states, deregistration is the way to go once Amazon starts collecting. So you're going to want to be able to turn in your last return. So I would collect through the third quarter of this year. And first quarter is when Amazon starts collecting. So I'd file that last return on October 20th or so, and then go ahead and deregister with the filing of that last return. There are some states where you're not going to want to deregister. A state like Washington, where you have the business and occupation tax, it's a second tax that's actually listed on the sales tax return. State like Connecticut, if your sales are above $250,000, they say you have to do at least an annual filing. So there are a handful of states out there where you'll still need to be registered depending on your circumstances. But by and far, most of the states, you either don't have to get registered going forward, or you can deregister once the marketplaces start collecting if you're only selling on a marketplace. You're selling on your own website, don't be getting deregistered because, a lot of these states, when they're figuring out these economic thresholds, they include marketplace sales. And even when they don't, in a lot of states, inventory at an Amazon warehouse still creates nexus. Who's responsible for collecting the tax and what's creating nexus for you are often two very different things. So you may have Shopify sales and maybe you're not over the threshold, but because you have inventory in that Amazon warehouse, the state can say you should be collecting tax on the Shopify sales. You have a physical presence in our state. So physical presence, it was not done away with by Wayfair. Economic nexus does not trump physical presence. It's one or the other or both that could create the obligation to collect the taxes for you.
And just a quick follow-up there, Mike. So for my average sellers, probably 90 to 95% Amazon.com. And most of them have, our most successful sellers have a larger percentage off of Amazon, but I would say the median is probably 90, 95%. And then they may have a smattering of either an international marketplace or say like Shopify, eBay. For those clients where maybe they've registered in New York, which I think was a recent change, they aren't going to be able to deregister. If I'm hearing you correctly, they're not going to be able to go back and deregister in New York, even though they're 95%. In other words, they wouldn't fall under the normal thresholds for New York, but since they're already registered, they got to stay registered. Is that kind of how that works?
It depends. If they're 100% Amazon, then you have no taxable sales, and most of the states say that you can go out and go ahead and get deregistered. If you have other sales and, it's kind of hard to say I'm getting deregistered because I don't have any taxable sales anymore when you do. Or it's kind of hard to say I don't have nexus if you still fit the threshold. So getting deregistered if you have more than just sales on a marketplace is going to be a little bit tougher and may not be so smart because sometimes the deregistration process in itself can throw up a red flag. So if you do have taxable sales, you don't want the state, looking at that. So it's getting to be better news for marketplace sellers, but it's getting pretty ugly out there for e-commerce sellers in general. I've been sharing this story. State of Utah, one of our clients got a call the other day, and they asked us to follow up. And the guy at Utah said, it's a brand new project. We purchased a list, and we're calling everybody in the country to make sure that they're signed up for our economic nexus. And it's just the first of, many increased enforcement efforts. So good news for marketplace sellers, bad news for everyone else.
And a little bit bad news for a marketplace seller that sells $100 a month on Shopify and every once in a while has a sale in New York but had registered a year ago. It sounds like for that guy, they are going to have to just bite the bullet and probably eat the compliance cost.
Or shut down the Shopify site. And that's
Yeah.
one of the things that a trend that we're starting to see. Well, why should I sell on these? I'm not doing a whole lot of business on them. Why should I have the increased compliance costs if I want to sell an extra $100 a month or an extra $200 a month or an extra $500? Well, whatever that number is, there are some people that it makes more sense to actually shut down. And that's one of the reasons why Amazon was in favor of, Wayfair going the way that it did, because it's just less competition for them in the long run. They're going to be consolidating a lot of the sales on top of what they already have.
Interesting.
All right.
That's my 2 cents.
Well, let's really quick here, just kind of wrap things up here. I want to thank everybody again for coming. I'll turn on my camera to say goodbye. Thank everyone. Thank you guys all for coming. We are really lucky to have you all here as guests. Mike and Tyler, do you want to say anything else?
Thank you, everyone. And, even though we don't have a survey today, I don't believe we have one, please let us know if this format works for you. We're thinking of doing a lot more, bringing a lot more people like Tyler on board with different outlooks, different industries, or different segments of the industry that they cover rather than what we do. And I personally think that, Tyler, you did a great job today, and just want to thank you.
And I would also just thanks everyone for joining us. And Ellie, Mike, it was good. I know these guys were in different states, but I've actually spent time with them. They really are the best in the business. And if I had any inkling to creep my firm towards sales tax, that was squashed over dinner one night, hanging out with Ellie and Mike, because they know what they're doing and I don't want any part of it. So I definitely couldn't recommend their firm highly enough, and I'm just grateful to have the opportunity to join you guys today.
Well, thank you, Tyler.
Thank you, everyone, again. And don't forget to, I send out the information to contact Tyler in the chat on the side if you guys missed that there, his email address and his website, along with ours. And we'll send you a follow-up email with that information as well. And we'll send out an evaluation so you can leave your feedback there. And thank you for the positive comments that we've gotten so far. We really appreciate that. So thank you again, everyone, and have a great afternoon.
Take care.